In 2026, a strange thing is happening. Millions of people are working full-time jobs, earning more money than their parents did at the same age, and somehow still feeling financially stuck. Not broke, not starving, just permanently behind. And a lot of them believe the solution is sitting inside a trading app, because every day, social media quietly pushes the same idea. If you're not trading, you're missing out. Quick profits, fast charts, daily gains, people making a month's salary in one trade. But here's the uncomfortable question nobody likes asking. If trading is really making average people wealthy, why are so many traders still stressed about rent, debt, and retirement? And why do most quietly disappear after a few years? Meanwhile, some of the financially calmest people you'll ever meet barely check the market at all. So in 2026, which actually makes more money, trading or investing? Not theoretically, not emotionally, but realistically, for normal people living normal lives in America and Europe. Because the answer is less exciting than social media, but probably more important. Imagine a 27-year-old software support worker living in Chicago. He earns around $72,000 a year. Sounds decent on paper. But after taxes, healthcare deductions, retirement contributions, and city expenses, his monthly take-home pay is closer to $4,300. Now subtract reality. Rent, $1,850. Car payment and insurance, $620. Student loan payment, $280. Utilities, groceries, phone bill, subscriptions, another $900. Then maybe dinners out, clothes, weekends, birthdays, random emergencies. By the end of the month, he's lucky if he saves $400. So naturally, he starts thinking, there has to be a faster way. And this is where many people enter trading. Not because they love markets, because they feel financially late. That feeling matters more than most people realize. People don't usually begin trading from a position of patience. They begin from pressure. Pressure to catch up. Pressure to buy a home. Pressure to stop depending on salaries. Pressure to feel financially intelligent. And modern trading platforms are designed perfectly for that emotion. Everything feels immediate. Green candles, profit screenshots, instant notifications, leverage, options, crypto volatility. It creates the psychological feeling that money should move quickly. But the financial system itself doesn't usually reward speed. It rewards consistency. And that difference changes everything. Let's look at simple math. Suppose someone starts with $5,000. They become an active trader. Some months are good, some are terrible. After fees, taxes, emotional mistakes, and losses, maybe they average around 5% annually over several years. That sounds fine until you realize inflation alone may eat a large part of that. Now compare that with someone quietly investing $500 every month into broad index funds for 10 years. Assume an average annual return around 8%. Not exciting, not viral, but mathematically powerful. Genuine, math block widget, always, prefetch v2e content. AP's left, one Xerox fracture night, not psi. With compound growth, that person could end up with roughly $90,000 to $100,000 invested after a decade. Not because they predicted markets perfectly, because they stayed in the market consistently. That's the part social media rarely shows. Most wealth creation looks boring while it's happening. Trading feels productive because it creates activity. Investing feels slow because it creates accumulation. But financially, activity and progress are not the same thing. And psychologically, trading creates a hidden problem most people underestimate. It changes your relationship with money. A long-term investor usually thinks, how do I steadily build assets over decades? A frequent trader often starts thinking, how do I recover losses quickly? That shift sounds small, but emotionally it's massive. Because once money becomes tied to short-term emotional swings, decision-making changes, people increase risk after losses, they overtrade after wins, they confuse luck with skill during bull markets, and during crashes, they panic exactly when patience matters most. This is why many retail traders experience something strange. Even after making money temporarily, they still feel financially unstable, because unstable income creates unstable psychology. Meanwhile, long-term investors often appear less rich early on, but much calmer later. Their wealth grows slower in the beginning, then suddenly faster, because compounding is psychologically deceptive. In the first few years, it barely feels meaningful. Then eventually, the portfolio itself begins generating growth larger than the person's own monthly contributions. That's when investing starts looking smart. But by then, most impatient people already quit. And this creates one of the biggest financial misunderstandings in modern culture. People compare trading profits to investing returns, without comparing stress levels, time commitment, or survival rates. A trader might make 40% in 1 year. That sounds incredible. But what happens emotionally after a 35% loss the next year? Can they repeat the strategy for 15 years straight? Can they manage taxes efficiently? Can they avoid revenge trading during recessions? Most can't. Not because they're unintelligent, because human psychology was never designed for constant financial stimulation. Markets exploit emotion better than almost any industry on earth. And in 2026, that problem is becoming worse, not better. Apps are faster. Information is non-stop. Financial influencers are everywhere. Everyone wants results immediately. But financially intelligent people often operate differently. They focus less on appearing wealthy and more on becoming financially durable. That means lower unnecessary debt, consistent investing, emergency savings, long-term ownership, patience during boring years. Nothing about that sounds exciting online, but historically, it's how most ordinary people quietly become financially secure. Not overnight millionaires, just people who eventually stop worrying about every bill, every recession, and every paycheck. And honestly, for most middle-class people, that's already a massive win. So, which makes more money in 2026? For a tiny percentage of highly skilled professionals with discipline, risk management, and emotional control, trading can absolutely produce enormous returns. But for the average person balancing rent, work stress, inflation, loans, and real life, investing usually wins, not because it's glamorous, because it's sustainable. And sustainability matters more than intensity when money compounds over decades. The uncomfortable truth is that many people don't actually need higher returns. They need fewer financial mistakes. That realization changes how you see money entirely. If you enjoyed this kind of calm, reality-based financial thinking, you can subscribe for more.